The housing market, one big house of cards that according to most experts is already in the middle of a collapse. Look anywhere from CNBC to YouTube to Jerome Powell and the trend is clear. The housing market is set to implode and on paper it makes sense. A large number of variables are flashing red. Mortgage rates have risen to nearly 6% and home prices are hitting new highs daily. The average payment went up over 70% year over year, and plenty of companies involved in real estate are warning of a slowing market, some even laying off a large percentage of their workforce. The economy seems to be headed towards a recession with the S&P 500 down 20% and Jerome Powell openly telling millennials that now is not a good time to buy. But what if I told you that everyone is wrong? In today's video, we analyze new data coming in that suggests maybe the alternative scenario is unfolding and real estate will continue its path forward uninterrupted by the recent downtrend in bonds and stocks. Guys, take a look at this heat map. Apple red, Amazon red, but look over there at that green. While everyone else is down 20, 30, 40%, art auction sales are up 32% for the year. In fact, the New York Times recently called fine art bulletproof. But art isn't just about stability. Art has outpaced the S&P by more than 2x from 1995 to 2021. More importantly, contemporary art has outpaced both gold and the S&P when inflation is above 3% with a price appreciation of 48% due to its increased demand as a hedge. We saw the same sort of resistance during the start of COVID when art's returns beat hedge funds, real estate, private equity, and more according to a 2020 report from Citi. Unfortunately, up until recently, most investors didn't have a crucial piece of the puzzle, a way to invest in art. But that's all changed thanks to a unicorn startup called Masterworks. They're securitizing paintings with the SEC so their 450,000 plus members can add art to their portfolios through fractional investing. And the track record speaks for itself. So far, each of the 4 paintings they've sold after offering them on the platform have delivered over 30% net returns to investors. So if you want to join hundreds of my subscribers already on Masterworks, you can skip the waitlist by clicking the link in the description for VIP access. But outside of art, bonds, stocks, gold, debt, and crypto, real estate is by far the largest asset class in the world. The argument everyone is focused on is simple. Homes rapidly accelerated in price over the past years, and with financial conditions tightening, interest rates have shot up nearly 3x in just a few months. This has made already unaffordable homes simply far beyond the reach of typical Americans. To illustrate this point, here's a quick example. 3 people borrow different amounts of money, yet they pay the same monthly payment on a 30-year mortgage. The first guy borrows $1 million at 2.5% and his principal and interest payments amount to $3,900 a month. The next guy borrows $736,000 at 5%. His payments also totaled $3,900, and the last guy borrows just $426,000 at 7.5%, and his payments once again totaled $3,900. This means that the last guy bought a house nearly half the cost of the first guy, yet his monthly payments were the same. The only thing that changed was the interest rate. That tells you that purchasing power has been decimated and the average buyer can afford less and less, in fact more than 60% less than those buying just 1 year ago. Simple logic tells us that this will squeeze out most buyers. You can see this in the data already. Redfin's CEO Glenn Kelman went on CNBC with a smile to announce to the world that the housing market is slowing down and therefore he had to let go of 10% of his workers. He cited price drops as one of the most worrisome statistics. In this graph, you can see that the percentage of listings with drops reached a high of 5.3% in 2019, yet today we have skyrocketed past this number, reaching 6.1% as of early June. While that difference may not seem like much, change the time frame and you'll notice that the deviation is growing quite rapidly. While in years past we've seen this number top out and come back down, this year it seems to be headed straight up. On top of this, leading indicators like mortgage purchase applications are down to record lows. In fact, over the last few weeks, we hit the worst number in nearly 22 years. Mortgage originator stocks are getting blown out. Rocket Mortgage, as an example, is down 73% from its peak, and various experts are looking at this as a glimpse into the future. But it doesn't take an expert to notice something about all of these predictions. We've went over this many times on this channel. Ultimately, as a home buyer, you should really only care about 2 things: the price of the home and the interest rate. Right now, neither of those things are coming down. Median home prices are at record highs, and interest rates, while they've cooled off in the past week or two, are still way above 5%. For these numbers to come down, what we need to happen is simple. Real estate, at the end of the day, is a market that functions on two things: supply and demand. And the biggest piece of evidence we have is inventory numbers. Bill McBride is the author of the Calculated Risk blog. He posts some of the most in-depth stats on real estate without bias and emotion. In one of his latest posts, he talks about how inventory will tell the tale. I've linked the full post in the description below, but here's the part I wanted to focus on. It may look complicated on its surface, but it's extremely important in understanding prices. What we have here is a chart where on the y-axis it's the months of inventory, essentially a measure of the number of houses available to buyers. And on the x-axis, month over month home price changes, essentially a measure of home prices. Now what he's done is map out these two variables throughout history, and what this chart shows is that when inventory is tight, aka you look at the top part of this graph, home prices tend to accelerate up. You see that right now we're at 2.6 months of inventory, which places us in this area, meaning that home price growth is expected if you look at history. In fact, with inventory the way it is right now, there's never been a time in history, at least not since this data was introduced, where we saw prices go down or even flatten. Given the tight conditions we are in, home price growth is actually very likely. Now, to be fair, he does go on to say that this year, inventory changes compared to 2021 are definitely suggesting that we're seeing a possible bottom in the inventory shortage. He predicts that we'll be back to 2019 levels by the start of 2023. And given this fact, we're going to see home prices decelerate and flatten out. Now, this is good news, but it doesn't show that we're going to experience a crash. Historically, for home prices to go down, what we need to see is about 6 to 10 months of inventory pile up. Right now we're at 2.6, which means given the current trajectory, it's going to take us well over a year of inventory growth just to even approach that number. In the years before COVID, we were hovering around that 4.5 mark and holding steady there. For us to truly have prices come down, we need to have a complete disaster unfold in the markets over the next year. Now, I'm not saying that could never happen, it's just very unlikely. Prices to go back to the pre-pandemic era will be nearly impossible, as it would require an almost 30 to 40% drop in most areas. That's never happened before in history. In fact, large drops require massive inventory buildups like the ones we saw in 2006 and 2007. You can see just how far we are away from that by looking at the existing homes graph. Now, many people will disagree, but the stats are the stats, and as always, past performance doesn't always predict future movement, and there's no reason to believe a random YouTuber on the internet. With that said, like I mentioned in an earlier video, I put my money where my mouth is by purchasing some call options on Opendoor. Now, I know this play isn't exactly perfectly correlated with the health of the real estate market, but I think given a steady market in the next year, the stock should come off its recent all-time lows. I mentioned I would keep you guys updated, and right now the position is up around 30%. Now, I'm not a financial advisor, and I hope you don't follow me into this. It's mostly a friendly play meant to counter the put options bought by another YouTuber, Reventure Consulting, who is playing the market predicting a downturn. As always, thank you for watching, and make sure you hit that like and subscribe button if you enjoyed it. Leave a comment whether you think I'm right or wrong. I would love to hear all the arguments for or against my outline.